Hi, this is Skyler with Regan Capital. Just an update on the curve that we've seen really since the Fed cut last fall. I have in here September 17th. That's a day before the Fed cut last fall. And then I have today's curve here in green. So that initial curve is yellow. You can see the Fed cut approximately 100 basis points. Front end of the curve went from about 490 down to about 4.25. Whereas the back end of the curve has actually risen precipitously, about 80, 82 basis points there, about 90 basis points on the 20-year. So I'm going to do the math. And the reason I'm bringing this up, and I bring this up a number of times, is we've had tremendous conversations with customers recently. And it really started back last August where folks were expecting rates to fall because the Fed was going to cut. They'd seen that playbook before over and over again, and they wanted to go long duration. So let's go through that math, what folks were expecting and what actually happened. So Fed's going to cut 100 basis points. The duration of the ag or the duration of core fixed income is around 6 years. So folks were expecting about a 6% move upwards in price, 1 times 6. And then from then to today, carry on the ag's been about 3%. Okay, so that's about 2/3 of a year times roughly 4.1. That's what the yield was on the ag. So folks, from then to today, we're actually expecting a total return of 9%. What actually happened? The 1-year part of the curve, as we saw in that chart, went from 490 to 429. The 2-year went up 36 basis points. The ag went up 66 basis points. And the 10-year went up 78 basis points. Okay. So if we multiply those figures times duration of each of those instruments, you could see over here, you get this market value change. So the market value on the change, instead of being +6, has actually been -4. Now, you do get carry, and in order to calculate carry, what we do is we take the average of those two yields, and we multiply it times the number of days that have gone by between September 17th and today, divided by 365. Over here to the right, you get total return. So the total return on 1-year bills has been over 3% over the last 8 months. You can annualize that, and we'll do that here. Let's annualize this. So we want to take this minus this divided by 365. And that's what we want to divide by. So I'm going to put that here. Boom. There's your annualized number. And we need to do this to drag down. So on an annualized basis, 1-year treasuries or 1-month treasuries have made roughly 4.7%. 2-year treasuries have made 2.8%. And obviously the ag and 10-year treasuries have actually lost money. So what is the playbook? What have investors should have done, and how do you judge this? Well, as we all kind of realize now, the Fed affects one part of the curve. They affect the front end of the curve. They do not affect the back end of the curve. There are other things at play like term premium. Let's bring up term premium. So this is kind of a guess. There are a number of different equations. So if we go back to last September, term premium on 10-year treasuries was 0 or 3 basis points. And today it is 55 basis points. Okay. So term premium has actually risen about 55 basis points, but also inflation expectations. So let's look at inflation expectations, and we'll get that via tips. So let's look at the break-even 1-year inflation expectations from last September to today. And this is a part of that. So back then, inflation expectations were 40 basis points. Today, they're about 280 basis points. So that's caused the back end to become unhinged. But again, if you own this part of the curve, as we kind of represented, you stayed very safe. If you own this part of the curve, what you were doing is you were speculating on the Fed cutting 5, 10 times over the next year. Remember when Fed expectations were 10 rate cuts over the following 2 years. But you were also going into this trade at much lower expected total return than what you could get on the front end. And let's talk about that. And let's fast forward to today, where total return, and I'm using pretty simple math, where this is the curve, this is 1-year futures, okay? And on a lot of these nodes, futures are expected to go up, so you're expected to lose money. And I combine those two, and voila, you're going to make a lot more money or a much better total return and much lower risk total return on the front end of the curve than you would in the belly or even going out to 10 years. And we see here some decent total return if you go all the way out to 20 to 30-year paper. Okay, and I'm not against that. If you do want to own the duration on the long end of the curve, ideally the 20-year part of the curve, and pair it with super short duration assets. T-bills. And just to look at real life products, let's pull up two big products out there. You have, first of all, LQD, which is the very large ETF that's fixed rate corporate bonds. Over that time frame, it's returned negative 320, whereas the floating rate component has returned positive 325. So you have a 640 total return difference in floaters versus fixed rate corporates. Now, how about T-bills? Okay. BILS is a big ETF out there. There's also T-flow, which is treasury floaters. So even treasury floaters have outperformed T-bills by about 19 basis points over the last 8 months. So what do you do when the curve looks like this? Stay short, stay floating rate. Thank you.